The markets, they're booming right now, thanks to the Federal Reserve and the federal government's massive stimulus money program. But what happens when it ends or when it just no longer works? Well, in this video, we're going to look at why the Fed can't just keep printing money forever, what risks it poses, and then what are the warning signs of when it's finally going to end. This is a massive bubble that's finally going to burst, and we're going to take a look at it, so stay tuned. All right, welcome back if you're new to the channel. My name is Mark Moss. I like to talk about making money. I like to talk about investing our money, the markets. I like to talk about having overall success in life. So if you like those topics, which of course you do, click on the like button right now so more people see the videos. Click on the subscribe button right now, hit that bell notification so you're notified every time I put a new video out. Now this is a standalone video, but it's also a continuation of the previous video that I did where I basically made the case that the markets still have a ways to go. Everyone's waiting for a crash. In the previous video, I said that, hey, the markets still have a ways to go. And as I said in that video, I can make the case really good either way. I can argue that the markets are going to keep going up for a while. I can argue that there should be crashing at any moment. Now, in the other video, it was the bullish case, why it should still go up. In this video, it's the bearish case. So if you want to go see the other video, you'll see it right up here. You can go watch that. For now, we're going to talk about when the bubble finally bursts, when the Fed finally runs out of ammo. And of course, in this market that we're in, I talk about it all the time. We see this over and over where everybody basically says, don't fight the Fed. Now, what does that mean? The Federal Reserve, they have so much money, they're printing, they're pumping trillions of dollars into the market, and it's pushing the market higher. So it's kind of that old saying, if you can't beat them, join them. And so don't try to beat the Fed, just bet with the Fed. We call it the Fed put, all right? Now, the Fed has made it abundantly clear that they do not want to let the markets crash, but at some point, they're going to run out of ammo. Now, for now, as long as they keep pumping the markets full of liquidity, then the markets should still keep going up. So if the Fed's gonna do that, like I said, then we just wanna bet alongside them. And so far, it's been working. It's easy to see if we go all the way back, just till 2008 to the great financial crash, you can see that the Fed ballooned their balance sheets during the financial crash. And then you can see in the markets how they shot higher from that stimulus. You can see again in 2013, the Fed increased their balance sheet. And again, the markets took off higher. You can also see in 2018, the Fed began to taper their balance sheet, trim it down, and the market started to decline. And then when they turned it back on again, as you can see, the markets, they took off again. So the markets are moving pretty much in lockstep with what the Fed's doing. The thing is, though, is that, like I said, they've made it abundantly clear that they don't want to let the markets drop. However, they've also given us some warnings that people shouldn't just depend on that. And the reason why is because eventually, no matter what, eventually the Fed's not going to be able to hold up the markets any longer, all right? The Fed's interaction, as they like to call it, stimulation, I guess as we call it, or probably manipulation, it's always going to run into a problem. And that is something called the law of diminishing returns. And so basically the law of diminishing returns is an economic theory that predicts after some optimal level of capacity is reached, adding additional is only going to result in smaller increases and eventually no effect, and then adverse effects. So the old, if a little bit works, how about give it more? Well, that's good. If a little bit's good, how about more? But then eventually it becomes a bad thing. Now, there's a great book written on this for the financial markets written by Bill Bonner, someone that I love to read. It's called Hormageddon. You can see it up here. And basically the basis of the Hormageddon book is that it's how too much of a good thing leads to disaster. And if you love my little mini history lessons that I do in my videos, then you're absolutely going to love this book. Bill Bonner chases this law of diminishing returns throughout history, showing proof from the Napoleonic invasion of Russia, the collapse of the US healthcare system, World War II, War on Terror, and on and on and on. And so anyway, check that book out if you like history and you want to see how too much of a good thing is bad. But really, we can see this in our markets, right? Where we can see basically every single pullback, every single crash where the Fed has to interact. Each response, it has to be bigger and it has to be faster than the last one because of diminishing returns. And so each new crisis leads to bigger and bigger responses. So in 2008, the TARP bailout with the bank, if you remember the great financial crash, 2008, the banks collapsed and we had to bail out the banks. They put together the TARP bailout and it was $700 billion. Back in 2008, that was massive. Nobody could ever even imagine that, $700 billion to bail out the banks. But today, it's trillions. Trillions of dollars, $2, $3, $4 trillion in just a couple of months, which is exactly backing up my point. It has to be more. So each crisis, it gets harder and harder to address this. And so, the Fed, not only does the response have to be bigger, but they start running out of tools. So typically the Fed would just lower interest rates. And by lowering interest rates, that was enough. In 2008, they actually had to start doing quantitative easing. Well, today, the interest rates are so low, there's not a lot they can do. So when the pandemic hit, rates were already so low that moving them down to zero, which is about as far as they could go, basically had almost no effect, minimal effect anyway. So they had to go in and they had to do the QE again, which they did. They had to start buying bonds. That wasn't enough. They had to start buying junk bonds. And the problem is the Fed starts running out of options. Now there's not a lot left for the Fed to do. As a matter of fact, I talked about it in a recent video you can see right here. That they only have really 1 or 2 more options left and then they're done. So the question everybody wants to know is when? When will it end? Now, as I say over and over, timing this thing is impossible. So it's better to know how it ends, all right? So if we know how it ends, then we can watch for the signs. Now, I always talk about this. It's like driving a car. I got directions. Someone wrote them down, turn right at the old mailbox, turn left at the sign, at the end of the fence, turn right. I don't know how long it's going to take to get there, but as I'm watching the signs, I know I'm getting closer and closer. And so we don't know when this is going to end, but if we watch the signs, we know when it's going to get closer and closer. And so really there's 2 ways this ends, all right? There's 2 ways. Good and bad. Let me break it down. So number 1, the good way is that the economy recovers and it closes the gap. The second one is basically the Fed goes till they blow. They keep it pinned until they can't anymore. So number 1, basically, like I said, the economy recovers and it closes the gap. Now, what do I mean by that? So to put this into easy to understand terms, think about your own personal finances. And I already hear all the people in the comments, the government's not like your personal finances. Well, it kind of is. We all follow the same laws. But think about your own personal finances. So if you were to take a hit to your income, like maybe what happened with the pandemic, you are short on income, so you could live off of debt, right? You could live off of credit cards. You could live off of a home equity line. And what happens is you're hoping that your income returns pretty quickly. All right, so you're racking up debt, your income takes a hit, you're racking up debt, but you're hoping that your income returns pretty quickly, and then you can pay off the debt that you accumulated to get you through that rough patch, okay? That's how it works. And so basically that's exactly what the government's doing. They're doing the same thing. So income and taxes have completely dropped. Well, income's dropped because taxes aren't being paid because nobody's working, right? And so the income has dropped for the government. In addition, they need all this additional spending, all this stimulus and things like that. They need to cover all that. And so basically they're doing the same thing. Their hope is that the economy will catch back up. Tax revenues will catch back up. The stimulus won't be needed anymore. And they're hoping that it's going to be able to come back up enough to bring back enough revenue that they can start to pay back the debt. They can justify the debt. They can justify these sky-high stock valuations that they've pushed things into. But as you probably know from your own personal finances, the more debt you take on, the harder and harder this gets. And so not only do we have massive debt, but then globally we have record unemployment globally. And at this point, there's no real path to getting back to normal. They say, up to potentially 40% of these jobs may never come back. A lot of industries are maybe kind of done as we know it. We don't really know. And so if we see this happening globally, and there's really no path getting back to normal, then this whole theory of hoping to close the gap seems to be diminishing on its own, right? That seems to be getting further and further away. And so if it's not going to close the gap, then what does that leave us with? That leaves us with option number 2, and that is that the Fed goes until they blow. But what does blowing look like? What does that even mean? What does that mean, go till they blow? What does it look like? Well, what that means is it gets to a point where it doesn't work, where nothing they do works anymore. The system is just too far gone, and then there's nothing that they can do. So adding more debt doesn't matter, right? It's like at some point, if you're out of work for so long and you've taken on as many credit cards as you can, at some point it just doesn't matter and you're probably gonna have to declare bankruptcy and start over. And so the government is racking up so much debt. In fact, the US debt, the debt to GDP, that's the amount of debt to the gross domestic product, the debt to GDP ratio is at the highest it's ever been. So we can't just keep printing more debt. Printing debt to service the debt. Now, of course, we can do it. We are doing it. We can do it for a while, just like you can with your own finances, but eventually it ends. Now, if a country could just print money forever, then Zimbabwe, Argentina, Venezuela, they'd all be rich. But the problem is money printed eventually leads to massive inflation, which of course we've seen in all those countries. But I hear it, the US, it's the reserve currency, you say, right? So of course we can do it. We're the reserve currency, yes. And so we've gotten away with it so far. That allows us to get away with it. It allows us to rack up this debt much higher and much longer than the other countries could get away with. But nothing lasts forever. And like I said, I've made several videos on the US dollar losing its reserve status. It's being chipped away. I've probably made a dozen videos about this. And the US dollar's reserve status is constantly being chipped away, constantly being eroded, even if we don't ever lose the reserve status. The other risk is that we create sky-high inflation, massive inflation. Massive inflation leads to larger wealth gaps, right? Those who own the assets see their wealth rise because they own assets. Those who don't own any assets, they just work for their wages, well, they see their purchasing power drop. And what that does is that just continues to get the gap between rich and poor bigger and bigger. The further and further the poor fall behind. So that's not going to work either. So the Fed, they're going to have to stop if they start to see the inflation. Now, in the previous video, I talked about this where I mentioned that the Fed has a new policy and they're going to, quote, run hot, let the economy run hot until they pass the 2% target inflation, which I made the case that you can't hit that accurately. There's just no way. So typically they start slowing down as they get there. But they're basically saying we're not going to slow down. We're going to let it run hot, which in my mind means that they're going to overshoot their target, which will eventually lead to a bigger bubble. It's going to get bigger and bigger and bigger, which leads us to the question, how long will we believe the market only matters if the Fed buys stocks, right? If everybody knows the market's only being propped up for the Fed, how long is that going to be okay? How long is that going to be acceptable? Everybody knows that the economy has to catch up at some point. So what is that point? Now, it's fantasy land to think that it can just work forever, right? We're already seeing the signs from what we call the smart money, the billionaires, the hedge funds, where they're basically opting out. The smart money's out, and the dumb money, it's me and you, the retail investors, the dumb money, we're jumping in. And I've made this case over and over. So the Warren Buffetts and the Druckenmillers, they're out. But the Robin Hood traders, the gamblers, because Vegas is shut down, they're in. And so how long is it going to work like that? Even with the Fed running full steam, it's just not realistic, right, to keep it going. I think it is realistic to see a 10, 20, 30% market drop sometime over the next 12 months. And I say that because the smart money, they're scared. The smart money is on the sidelines and we should be listening. So how does it end? That's the question. How does it end? So if the real economy can grow, it could close the gap, okay? Then there's no bust. Then that's the ideal scenario. That's what we want to happen. But if we have slow growth, which it looks like it's going to happen, like these businesses aren't coming back, we have slow growth, then closing that gap becomes less realistic. And the Fed's going to have to walk away. And if they do that, when I say walk away, meaning they can't keep injecting forever. And when they do that, just like we saw in 2018, the market stopped crashing. So we can't have that. So the next option is the Fed just keeps pumping. They keep pumping until it doesn't work anymore. Hence what I said, they're going to go till they blow. And if that's the option, then how long will it take to get there? Now, that's the question everybody wants to know. How long will it take? When will that happen? And I hate to tell you that I don't know. But again, we're watching the signs, and I do know that you need to be prepared. You need to be prepared for anything because in this market, it's super volatile. It's most frosty at the top. We're having huge run-ups and we're having huge corrections, which, like I said, to see a 20 to 30% correction sometime in the next 12 months is totally probable, totally realistic, and we can continue to pop up higher from there. So we need to be prepared for anything. We need to be prepared to stay in the market. as they push the asset prices higher and higher and higher and faster than anyone could imagine. But we also have to be prepared for the crash that can happen without warning. And there is a way to do both. Sounds a little bit crazy. Most people think they should just stay out of the market. But if you stay out of the market, you risk getting left behind as assets keep pushing up. But if you're just jumping in blindly buying stuff, you risk getting caught in the crash and losing everything. So there is a right way to do this. You just need to have the right strategy. Now, I know this video is already going long, so I can't break the whole strategy down for you. There's quite a bit to it. However, I am having a 1-hour training where I'm gonna break this whole strategy down, exactly how you can figure it out for you, custom tailored plan, so you can stay in the market and stay long and get this massive upside, but also be ready for the market when it turns on a dime. There is a way if you build out the strategy, and so I'm gonna put this 1-hour training together. It's all for free. You can click on the link, it's in the description, so you can sign up and you can get the more information from that. And that's it. I hope to see you there. Let me know what you think about this video. Do you think the market is going to close the gap as the Feds hope? That's the hopeful solution, number one. Or do you think number two, the Fed's gonna go until they blow and we're gonna see this whole thing go until the market bursts? Which one do you think is gonna happen? Give me a 1 for closing the gap. Give me a number 2 for go till you blow. And then make sure you're prepared. Anything can happen. If you've got it on your own, good job, good luck. If you want a little bit of help, come to the hour-long training I'm doing. There's a link down there. It's for free. Highly advise you to come check it out. And that's it. That's what I got for you. To your success.